Nigerian market did actually have a positive, very strong opening actually. I think in the first 1-2 hours of trading, the index was up about 1.5%. Although that slowed down towards the end of trading. But I think it's a trend that we've continued to see. Very strong performance from the banking sector during the trading day. A lot of that is the fallout of the signing of the AMCON bill, as well as the signing of the first tranche of non-performing loans by the banks. So it turned out to be a strong day for the market. That's a trend we perceive might continue during the early weeks of the year as people react to the actual operations of AMCON in the market. Now, the implications of that for the medium term is still that we still think that the first half of the year will reflect a lot of the uncertainty around the political space. But for trading today, quite an interesting day.
Looking at the bond market, because that seems to be a very focal point, not only for the banks in Nigeria, of course, with AMCON signing $1 trillion worth of bonds Naira worth of bonds not too long ago. But looking at the overall picture, it seems that there is going to be oversupply. Is that a concern for investors going into 2011?
Definitely, most definitely, there will be quite a bit of crowding out. We actually think that there's going to be a lot more pressure on interest rates as a result of the crowding out of the private sector by government. There are a number of state governments and subnationals who are looking at approaching the stock market, the capital markets for some form of bond issuance or continuation of programs that they had started earlier on. That will put pressure on bond yields, and a lot of that pressure is going to be on the upside in terms of where we think bond yields will be going to. There are also supply concerns at the primary market space. $1 trillion is quite a significant chunk of cash. You're talking about $7 billion from AMCON's point of view. If you put that against the fact that the federal government already has an ongoing bond issuance program, which the DMO currently runs, as well as the sub-sovereigns that we're expecting. It means that even corporates that will be competing with those national instruments will be facing quite a significant challenge in terms of pricing. And we think that that will reflect in the sort of performance you would see from the bond market in 2011. If you put that into perspective as well, is the fact that the bond market had significant overbought events during the middle part of 2010, and people are still struggling with unwinding those positions. A lot of institutions are probably going to just hold those instruments to maturity, which means that you might see less liquidity from older issued instruments. But in terms of the newer issued instruments, I think that the yield expectation from investors will go up, and that would put significant pressure on other interest rates tracking instruments.
Femi, what do you think the biggest risk is when it comes to the bond market? As you alluded to, a lot of the institutional investors perhaps will just wait until the bonds reach maturity. Do you think that there is a possibility that we could see a massive sell-off?
It isn't unlikely, but that means that for us to have a massive sell-off, I believe that there's got to be significant macro shocks to investors. So it either means that we have a very high interest rate environment, which means that the yields or the coupons on those instruments, the yield to maturity becomes lower than the cost of funding for those institutions, at which point they have to start looking at that, probably piling out of the instruments. But I think that for the shorter end of the curve, most investors would want to continue to hold to maturity, because if you are holding 3-year instruments and inflation continues to hold at current levels, then you can cap your losses. But for the longer end of the curve, that is from 7-year to 20-year instruments, then there starts to be that concern for investors saying, look, from a YTM point of view, it's probably better for you to recycle your portfolio and buy more recently issued instruments as against holding your portfolios to maturity. So I think that from a duration point of view, investors are going to be focusing on duration of their portfolios. And if the duration of your portfolio is more in favor of the longer end of the curve, then you will be looking at shifting to the shorter end of the curve if volatility continues. And that's where I see a massive sell. sell-off and the long end of the
Femi,
curve.
let's touch on the foreign investor looking at a frontier market such as Nigeria as an investment opportunity. Increased interest coming through, and it seems that despite the debt overhang in some of the developed countries, there's still a lot of interest in the likes of Nigeria. How could political factors affect the view of foreign investors wanting to come in and purchase bonds and purchase equities?
I think it's going to be a major concern for anyone looking at Nigeria. Whilst Nigeria is not likely to go the route of Ivory Coast, there are still obvious political issues that need to be resolved, and resolved very quickly too. The expectation is that for the PDP, for example, by the end of this month, we should know who the presidential candidate is. I think once all of those issues are beginning to clear out, and we have clear direction in terms of the main political parties, the PDP, the ACN, and some of the other smaller parties, once we have some level of clarity as to the direction and the candidatures that those parties finally settle for, the political environment may become a bit clearer. However, I think that the 2011 elections would be a major litmus test for Nigeria as to the direction of the economy, the direction of the country itself from a socio-political point of view. Nigeria has witnessed probably in 2010 a lot of social issues that were never in play in the past. So investors will be looking at that. The level of security is probably another issue that investors will be concerned about. And to say that if the space of bomb blasts, for example, or the space of armed struggles that we're seeing continue to get worse, then investors will start to ask themselves whether that could have significant long-term impact on the macro level. But our take is that, look, we will see a lot of noise before the elections, but the elections are likely to go smoothly, with pockets of violence here and there. But the underlying fundamental, how comfortable people will be about those election numbers wouldn't be as bad as it was in 2003 or 2007.